Stick to the status quo, and that's exactly what the market did today, with the mega caps leading and the broader market got dumped as yields rose in the face of what looks like heavy election uncertainty. But with the first trading day in the second half of the year complete and the equal weight only gaining 5% for the year while the Nasdaq gained 15% plus, when will the broader market begin the move we're all waiting for, or is tech dominance simply too much? Today we're going to talk about that, as well as the quarter that was and the quarter upcoming. We're kicking July off with non-farm payrolls as the first major macro release for the quarter, and this will definitely set the tone for the weeks and months ahead. So what should we expect for non-farms in light of the recent inflation data? Today, we'll be talking about that, our expectations, as well as sentiment, seasonality, earnings, and of course, the consumer. Are things really as good as they seem? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500. Very, very obvious to see the broader market got sold in favor of the bigger names in every single sector. Microsoft, Nvidia, Apple outperformed the smaller names here in the tech sector. Google, Meta, Income Services. Look at Amazon, look at Tesla with regards to discretionary, including this small apparel, getting a bit of a dead cat bounce here after the massive sell-off we've seen in the last couple of weeks. Same thing here in healthcare. Look at the growth names in healthcare relative to the defensive names. Financials were a little bit stronger. It's just that the bigger bank names were bought in favor of, stuff like asset management, regional banks, insurance. But what did buck the trend in the broader market today was actually energy. They outperformed the broader market, and that's because of concerns in the Middle East, also declining US rig count with regards to oil, as well as the Atlantic hurricane, which is driving up prices. And that meant the energy sector gained 0.05%, and it actually underperformed the SPY along with semiconductors. But the only sectors that actually beat the SPY were financials, discretionary, and then technology, so like software, tech, and then XME, the metals sector. Every other sector underperformed the SPY. And if we actually have a look at what sectors underperformed, right, we can see that we actually have XLC right here. Now, I do know that Google and Meta are part of the sector. Now, there's a large component of the XLC, which is a defensive sector, telecom services, right? So we had XLC in defensives, then we had XLV, XLU, XLP. These are all like defensive sectors that just didn't perform well today. Then we also had regional banks, XLRE. So these are rate sensitive sectors. And then we had a couple of other outliers: home construction, industrials, materials, and then GDX. So what actually lost on the day? It was rate sensitive sectors and defensive sectors. And again, the market's back to risk on, but it's not risk on in terms of smaller size. It's just risk on in terms of large caps and growth sectors. And part of the reason why we actually saw, I guess you could call, a rotation into the larger cap names actually had to do with yields. Yields rose for a second day in a row after the big move on Friday. So on Friday, yields were up 2.71%, and again today up 1.48%. Actually, if you measure from the lows here at the 4.2% mark to where we closed today, yields actually rose 6.25% from the 4.2 to 4.4 level. And yields are rising because of the presidential debate that just took place. Investors are bracing for increased government spending in the case of a Republican sweep following last week's debate. That means higher odds of legislative support to a potentially spendthrift agenda that would require more bond issuance, which in turn would decrease the value of current treasuries. Pretty much reflation tactics from Donald Trump's and the Republicans' campaign. That's why yields are rising in reaction to that. And this is obviously putting pressure on stuff like the IWM. It was down 0.84% today. The equal weight down 0.81%. And that's a very, very ugly bearish engulfing candle. Mid caps 2 down 1.01%. Small caps as well down 0.85%. And this is the S&P 600 profitable small caps. Because of the movement in yields, bonds had a very, very ugly day. The AGG was down 0.84%. TLT was down 2.04%, but a little bit of upbeat action here in the after hours. A lot of volatility in the dollar as well. So it was pretty much flat on the day, but look at that candle. That is definitely something you don't want to see in the DXY. Now, looking at commodities as a whole, gold continues to defend this 2300, 2293 line. Very, very critical line right here. And it does look like, investors are buying the dips at these levels right here, supporting price. So I think if we do get here, we are finding very, very solid support, and it's just a matter of time before we bounce up and rally. I do think it's going to be time to get into commodities. I am in silver, which was up 1% yesterday. And again, bouncing off this $28, $29 level right here. I do think silver is going to go higher. I think commodities are just coming under pressure due to what we saw in yields. But crude was the outlier today, actually breaking to the $83 level. And this is definitely not what Joe Biden's campaign want to see leading up into the election. we've seen a massive move from the $72 to the $83 level. Now, I've been saying this for a very long while. The $87 to $77 level is probably where crude is going to trade for the rest of the year. So we can actually go higher. I think we actually do go higher after this candle. And then, sort of around this $86, $87 level, we can find a bit of resistance and then move back closer to the $80 level. But crude at $83, energy stocks are probably really liking this. Think about something like Oxy. They have $65 break-even Permian with $83 oil. Wow. But diving into the S&P 500. So guys, we looked at the monthly chart in the weekend video. So go ahead. We did a full deep dive on the monthly chart because June just closed up, the weekly chart as well, and the daily chart. Now you can see here that we continue to, I guess you could say, trend sideways like we have for probably the last 5 to 10 trading days. Although we are in an uptrend, and year to date, the S&P 500 is up well above 15%. As we trade sideways, we're actually working off a lot of the overbought conditions that we've actually seen here in the S&P 500. And as the RSI has gone down, we've actually seen a flat in the S&P 500, trading flat on the upper end. This is actually a positive divergence, and oftentimes this does lead to higher price action in the S&P 500, but it's not really reliable. I think something far more reliable is actually looking at something like the advanced decline line. And we can see that market breadth, while it did show a little bit of improvement in the last week, is starting to come down again. And we do know that. Look at the NDX, look at the IWM, look at the RSP, look at the changes in each year on the day. Clear rotation into the bigger names, but that is okay, because the thing is, the mega caps normally lead. We are entering into a new month in the second half of the year. As long as market breadth goes ahead and actually improves, breaks all-time highs at a later date, this is completely fine. The mega caps normally lead. It's what we've seen in the last 5 years. The mega caps lead, and then the broader market tends to follow. It's just the market environment we're currently in. But the biggest bullish market indicator actually has to do with the gamma chart. We actually saw a move up from the 5500 to the 5600 in the gamma flip zone. We also saw a move up in the put support from 52 to 53, as well as the gamma flip still at the 54.45. That is bullish. So the game plan now is to buy dips, sell rips, look for opportunities to get into the S&P 500 as we do make our way to 5600 here in the S&P 500. That is the July OPEX target that we are aiming for. I think looking for buy opportunities here at 55.40, maybe even as low as 5400, and targeting 5600 will be great risk to reward right there, especially when we have the options market on our side. Now the 5500 strike is quite built out as well, and the 5600 is just the bigger strike. We have to pay close attention to these to see if they do take turns in leading for the day. But something else to note, the 5700 and 5800 strikes are also building out relatively well, but the 5300 strike is very big as well. But we are in positive gamma, and we do want to be buyers of dips, sellers of rips all the way to the 5600 area. And that is our next target. So the target we're looking at is right here. So that's what we're aiming for. We just want to look for opportunities to get in. You should really already be long from these levels, but we're looking at the 5600. That is the new target for the S&P 500. So very bullish that we actually got that. Pretty much what that tells us is that the options market, traders and investors, they're rolling a lot of their strikes up from the 5500 to the 5600 area. And that is often a very bullish indicator. If we at the same time can also see market breadth improve and participation in the RSP, IWM, mid caps, small caps, we can see participation from all of these names, market breadth improve, 5600 being the core gamma strike, and then movement in the entire market to the upside. That would probably be the most bullish thing that the market can do right now. But as it is, we did move up to the 5600 area, and I think, the mega cap names are probably going to rally first, and then we're going to get the movement in the broader market. And if the mega caps are rallying, the S&P 500 will continue to march higher, step higher. If we do get pullbacks to the 5400 area right here, we want to buy those dips, because we probably are going higher to the 5600 area. I don't think we're going to fall apart here in July. I'm talking about seasonality later on in the video. July seasonality is pretty much from the bottom left to the top right, looking at literally just a very bullish month. You don't want to fight the options market. You don't want to fight the mega caps. You don't want to fight the trend. The trend is up on the monthly, weekly, and the daily. You don't want to fight the trend. You don't want to fight the options market. You don't want to fight seasonality. Everything is pointing for higher price action here in the S&P 500. And if we do get volatility, buy those dips. So the first half of the year just wrapped up. The S&P 500 up 14.48%, kind of crazy in the grand scheme of things. And we have some seasonality as to what comes next. just a bit of history to answer the question, should we get ever more so bullish? Should we hold? Should we sell? What should we do? Now let's go ahead and read. So 2024, the first half, is the 26th time that the S&P 500 has rallied between 10% and 20% during the first 6 months of the year. This positive setup shows the S&P 500 up 88% of the time in the second half with an average return of 8.58%. That would put the S&P 500 at 59.25 and median returns of 6,010, up 10% in the second half. So you know the saying, guys, momentum brings momentum. We can actually see it right here. After a positive first half, average return 5.7%, median 6.56. 74% of the time up. But have a look what happens when we get a negative first half. We actually get average returns in the second half of 1.33%. And after a 10 to 20% rally, we normally get 8.58% return, median 10.13. Absolutely crazy. We can actually see maximum return right here, 23.18. Minimum drawdown, 21.74. Standard, this has been observed 25 times. And the difference between this and this is the fact that the percentage of the time up is 88%. So the risk to reward with this, absolutely insane. So you want to hold and maybe even add to equities. You can see in a presidential election year, it is no different. After a positive first half, we can see average returns 6.98%. Median returns 5.47%. That would put the S&P 500 at 58.40 and 57.55, and percentage of the time up is 88%. So guys, we've had a stellar run in the last 6 months and it is going to continue because history tells us so. Now let's keep diving into some data in the S&P 500, and this is very, very interesting. Now this right here is year-to-date contributions of every single sector towards the total return of the S&P 500. So you can see here, S&P Global have the first half of the S&P 500 returning 15.29%, and this is 100% of total return, right? Now this is how this works. Information technology, the technology sector, returned 8.02% in the first half. This 8.02% accounts for 52% of S&P 500's year-to-date return in 2024. This 8.02% is 52% of this number right here. And pretty much if you add up all of the total return contributions, or in the case of real estate, subtract it, you get the full S&P 500 return of 15.29%. This is the nominal return. This is the percentage of total return. Now, the best performing sector, obviously information technology, almost half of all returns in the S&P 500 was from infotech. So you definitely need to have exposure to the sector, whether Microsoft, Nvidia, Apple, because it really does produce the majority of the gains. But what this also tells us is that if you actually remove the technology sector, you still would have actually received a 7.27% return in the S&P 500 without the tech sector. And here's a fun fact. The average year in the S&P 500 during the first 6 months is only up 4.2%. So even without the tech sector, we nearly doubled what the average year is. So you take out the leaders and you still have fantastic returns here in the S&P 500. In second place was comm services, 2.31% of the total 15%. This accounted for 15% of total nominal returns. In close third and fourth place was financials and healthcare, returning 1.41 and 1.08%, which accounted for 9% and 7% respectively of the 15.29% returns. And then every other sector was generally between 2 to 4%, with the only negative sector being real estate, returning 0.08% for the year on a nominal basis, which accounted for 0.5% loss in total nominal returns. Moving on into sentiment, we can actually see here that even though we've been very, very bullish in the last 6 to 12 months in the S&P 500, we're not quite at this extreme bullish zone. In the BOFA bull bear indicator, we're sitting at the 6.2 area right here, which means we still actually have room to run to the upside. There's still a lot of gas in the tank, and the Goldman Sachs sentiment indicator says the same thing, sitting just in the stretch positioning at 1. We're actually sitting at this equilibrium zone, and we're actually in a very healthy market environment. Despite all of the momentum we're seeing, there's still gas left in the tank for the S&P 500. However, market breadth is not looking that great. Currently, market breadth is sitting at 14. Absolutely atrocious atrocious breadth, but I do have some amazing stats right here. Listen, in years of mega cap leadership, since 1986, the market was up the subsequent year 75% of the time. This is years when the largest 50 stocks outperformed the S&P 500 and the subsequent S&P 500 return. Now here it is. This right here is the performance of said year, and this is the subsequent return in the S&P 500. So when we've had the mega cap 50 lead, what are the subsequent returns we can expect? And you can see average returns 12%, median 16.3%, hit rate 75%. What does this mean? You want to be long and you want to actually add to equities here. Yes, we could definitely get some volatility, and we are starting to see a rotation into the broader market, small caps, mid caps, that type of stuff, but it does not mean that equities, mega caps, large caps are going to underperform. Quite the opposite. We could see 12% returns, which is above the S&P 500 average of 9.8%. So momentum brings momentum. You want to hold equities and you want to sit through the volatility and add on any pullbacks we do get in the S&P 500, because higher prices will ensue. Now, what is the reason for the stark mega cap outperformance? Now, we have a note here from Capital Economics that can actually explain all of this. We don't see any reason for EPS expectations to fall back. As such, we have revised our S&P 500 forecasts to 6,000, 7,000 for year-end 2024, year-end 2025, up from the previous figures of 5,500 and 6,500. The new numbers would reflect broadly similar price to earnings ratios to those we previously anticipated, while accounting for stronger than expected EPS outcomes so far and allowing for some future growth. And essentially, Capital Economics just expect the consensus earnings per share growth to materialize, and that to propel the S&P 500 to the 6,000 and 7,000 mark by the end of 2025. And these are the consensus expectations. In the second quarter, we are expecting 28% growth in the Magnificent 7, 4% in the 493, and this is expected to decelerate for the Mag 7 to 16% in the third quarter and accelerate to 5% for the 493s. And then by the fourth quarter, we actually see growth accelerate for both the 493 as well as the Magnificent 7 to 17%, and then huge uptick from 5% to 17% in the 493. Now, these are the consensus expectations, but Goldman see it a little bit differently, where the consensus expectations for 2024 is 9% and then 14% in 2025. Goldman actually believe we're going to get 8% here in 2024 and then 6% in 2025. And this is a very stark difference, because if you actually look at the consensus expectations, if we are to get these major down revisions, that is not going to be good for equities, because right now the consensus expectations is priced into the S&P 500. Now, this doesn't mean stock markets are going to fall apart because Goldman's expectations and the consensus are completely different. You can actually see, if we have a look at sales growth right here for 2024-25, 6% both was expecting in 2024, 4% in 2025, so pretty much 5% annualized. That's actually the consensus expectation as well. The only difference is consensus expectations expect profit margins to go to 11.7%, then 12.8% next year. Goldman actually see 11.5% and then 11.7%. So actually still sales growth as well as margin expansion into the next 2 years. It's just that the consensus growth see a little bit more margin expansion, and that's why we get a higher earnings multiple in the form of earnings per share, and by extension a growth rate. So don't expect the market to fall apart even if these earnings don't materialize, because as long as we get top line sales growth at around the 5 to 6% level and earnings are still expected to be upbeat in the next 12 months, the market should remain resilient and we should continue onward and upward in the S&P 500. And so with regards to all of these earnings, where does that leave us with S&P 500 valuation? So right now, the S&P 500 is trading at 21.3 times, PEG of 1.2, a free cash flow yield of 3.2%, price to book at 5 times, EV to EBITDA 16 times, and EV to sales at 3.2 times. So the index as a whole looking really pricey, but the only two sectors that are trading above the PE of the S&P 500 is consumer discretionary and information technology. In fact, they're trading at 24.8, 30.1. Every other sector is significantly undervalued relative to the S&P 500. And that goes to show that these two sectors are really boosting the actual overall multiple of the S&P 500. In fact, if you look at relative valuation and its historical average based on PE, you can actually see that the S&P 500 is 1.6 times above its average PE. Its average PE is about 16, 17, maybe 18 around there. We're trading at 21 times. But if you actually have a look at individual sectors, the only sector that's trading above its historical historical average is infotech. Every other sector is trading below its historical PE ratio, which goes to show just the weight that technology has in this index. Look at stuff like materials, utilities, even comm services, 1.3 times below its median average PE. So right now, comm services trades at 19.6 times. So the average PE would be closer to like 21. That's great value right there. And real estate trading almost 2 times below its median Z-score. So very, very interesting dynamics right here. So, you know, a lot of the market valuation is dependent on technology. In fact, you're looking at relative value in literally every other sector in the S&P 500. And that's why it's probably best to diversify into a lot of these other sectors, because in the very long term, you'll probably get outsized returns. Now let's dive into some economic data. So Fed's GDP now sitting at 2% or just above the 2% level right here, which is about the blue chip consensus. We saw a massive uptick right here, and now we've come back to, I guess, revert to the mean. Again, that's where the average consensus is, and that's about where Goldman sees GDP for the second quarter at about 2.1%. It's exactly where the Fed's GDP now is sitting. We can also see that Goldman Sachs actually see acceleration into the third quarter of 3% GDP growth, and then deceleration by 2.5 and then 2% in the fourth quarter and first quarter 2025. And then we should see a steady 2% GDP into the rest of the year. Now, even though GDP will be decelerating, as long as earnings holds up the way we expect them to, that should be very good for the overall market, because while GDP and EPS rarely diverge, slowing GDP and accelerating EPS has historically been the best backdrop for equities. We also do know that earnings per share for the broader market is expected to accelerate in a very big way in the second, third, and fourth quarter of this year. And while GDP will slow, as I have just showed you, that's generally been the best backdrop for equities. And we have the data right here. You can see that decelerating GDP and accelerating EPS growth sees average returns of 3.6% versus accelerating GDP, accelerating EPS of 2%. And then in the opposite camp of decelerating EPS and decelerating, accelerating GDP, which is normally 1.8% and 3.1%. So right now we are sitting and could potentially be in the best environment for equities and for the S&P 500 on a quarter-over-quarter basis. Now this actually only occurs about 11.2% of the time. So when we do get this, we want to be long equities because momentum brings momentum. And at times when we do get stuff like accelerating EPS growth, decelerating GDP growth, and then we actually get accelerating GDP growth, we could actually see like average returns of 3.6% and then continued gains, and we just sort of get the stair step higher for years and years on end. That's what happens in bull markets. So you want to be long equities, you want to hold equities, and you just want to sit through the volatility, because all the data right now is telling us probably go higher into the end of the year. We know this from seasonal data, historical data, quantitative data, everything I've showed you in this video. Guys, looking at some charts, we're going to dive into seasonality, and we can see right here that the S&P 500 in 2024 against every other election year is actually the best performing election year on a year-to-date basis. Kind of crazy to see the strength we have in the S&P 500, and the truth is momentum brings momentum. By the looks of everything, it's very, very likely that we are actually going to finish higher than what we are right now. So any dips we do get in the market, buy those dips, because they can often be far and few between, and July is no different. This is S&P 500 seasonality for July from 1950 to 2023, a huge pool of data. And generally speaking, what we do is we get a huge ramp up first half of July, then from about the 17th to late July we trend sideways, and then we get a little bit of a rip again right here. We don't make lower lows, we normally make higher highs in the S&P 500 and finish at a high, and that probably means we probably see with average returns about 1.3% here for July. So guys, momentum brings momentum, and the same is true for the Nasdaq. Now this is the full year chart, and what we actually normally get a ramp up 12 days of just like higher highs, higher lows in the Nasdaq 100. It also correlates with what we generally see in July in the S&P 500, sort of like a ramp up in the first 12 to 15 days. If you do actually see the indices running up in the first couple of weeks here in July, it's completely normal. History tells us that's what normally happens. But then after we get this massive ramp up, it seems like we pull a couple of months worth of gains within a few days, because then the Nasdaq sort of just trades sideways for a good couple of months, all the way from about mid-July all the way to as late as November, and then we sort of get this Christmas rally right here. So any dips we do get in the market, you kind of want to take advantage of them right now because we are in that time period of the year where we do see a lot of upward volatility that can knock the socks off investors. Now, data for this week, the focus is going to be on non-farms and FOMC minutes. A lot of the big data is actually going to be in the back end of the week here on the 3rd. The 4th and the 5th, we get the FOMC minutes, initial jobless claims, and then a non-farm payrolls. At the start of the week, we get stuff like ISM manufacturing, JOLTS, total vehicle sales, ADP employment figures, and these should give us a real robust understanding as to where NFP sits. Now, the BOFA estimate and the consensus are as follows. The consensus figures for changing non-farms is 195K, 160K private payrolls, an unemployment rate of 4%, average hourly earnings month over month of 0.3%, and weekly hours of 34.3%. The BOFA estimate for non-farms is 200K, private payrolls 170, so they see a little bit upbeat action in the employment figures, a 4% unemployment rate, average hourly earnings of 0.3%, and then average weekly hours of 34.3%. So BOFA see a little bit more upbeat action here in the non-farms, but the BOFA estimate and the consensus is roughly in line.